Prices are dropping across Oakville, Burlington, and Mississauga. But here is the twist. Inventory is piling up, yet homes in Niagara-on-the-Lake are taking 5 months longer to sell. What's driving this unusual slowdown? And why are buyers suddenly disappearing from the market when rates barely budged? If you think this means it's a buyer's paradise, think again. Mississauga's market is quietly reshaping itself, and missing this shift could cost you thousands or years of waiting. This video is part of an exclusive collaboration with top real estate YouTubers from across North America. We are each breaking down what's really happening in our local markets, the stuff you won't hear on the evening news or read in some generic market report. If you want the real inside scoop on what's going down in markets beyond your own backyard, make sure you check out all the videos linked below. These aren't just the random YouTubers. These are people who know their market inside out. Have you noticed how quickly market confidence shifts the moment interest rates even hint at softening? Just a few months ago, sellers were frustrated, buyers were cautious, and listings were sitting. But the latest numbers across Mississauga, Oakville, Burlington, and Niagara-on-the-Lake, they show much more nuanced story. One of subtle shifts happening beneath the surface. Today, we are diving into the December 2025 market stats, not just the raw numbers, but what they really mean for you. What's actually unfolding in our local markets, and how can you use this insight to make confident real estate moves in 2026. Let's start with Oakville. Oakville's luxury real estate is recalibrating. Here, detached home market has seen a clear adjustment. The average sold price dropped nearly 7%, sliding from about 1.86 million down to 1.73 million. That's a significant pullback for a city often setting the GTA's luxury tone. Even more striking is sales volume, down 44% from 110 homes to just 62. Months of inventory climbed from around 4.5 to just over 7. At this rate, it would take more than 7 months to sell out current listings if no new homes came into the market. That signals a buyer's market, but not because buyers are rushing in. Instead, sellers are holding back, waiting for more clarity. Despite prices dipping, average days on market barely shifted. 42 days last month, 45 now. That tells us homes priced right are still moving. Buyers out there are serious, but choosy. New listings took a big hit, dropping nearly 60%. That's the real story here. Not panic, but pause. Sellers are stepping back. Buyers are quietly watching for value. Townhomes in Oakville tell a different tale. Prices actually rose more than 13% to just over 1.1 million. But sales shrunk by more than a third, down to 39 units. That's a small sample size. So, a few high-end deals can push prices upward fast. New listings for townhomes also plummeted over 57%, tightening inventory to nearly 5 months. That's enough to cause pricing swings even if demand isn't dramatically changing. Condos in Oakville are feeling the biggest squeeze. Prices slipped about 1%, but months of inventory doubled, jumping from 7 to over 14 months. 14 months of inventory means oversupply. Plain and simple. This reflects the impact of investor-owned pre-construction units now finishing in a cautious market. So Oakville's story is this. Detached homes are adjusting downward. Condos are softening considerably. And townhomes sit in the middle as families look for a balanced lifestyle without stretching too far. Luxury isn't gone. It's just moving to a slower beat. Burlington, which is moving stably with caution. Heading west to Burlington, the market looks a bit steadier. Detached home prices dipped just over 3%, settling around 1.28 million. That's a softer correction compared to Oakville. Sales were down by 20% and new listings fell over 56%. Yet, months of inventory actually improved, slightly to 3.7%, signaling more balanced market. Buyers and sellers have negotiating again, and they are not desperate or panicked. The sweet spot remains between 1.1 million to 1.3 million, especially in family-friendly neighborhoods like Aldershot, Brant Hills, and Millcroft, where community and commute still drive demand. Burlington townhomes slipped nearly 5% to around 747,000. Interestingly, sales slightly ticked up. Demand hasn't vanished. It's moving upward. Inventory for townhomes tightened under 5 months, which means well-priced homes in the right spots still move relatively fast. The condo market took a big hit, with average prices down 25% to about 627,000. Inventory surged to over 9 months. This reflects investor fatigue, slower rental absorption, cautious pre-construction completions, and fewer first-time buyers in the mix. So Burlington's story? Detached homes hold steady, townhomes quietly perform, and condos are recalibrating sharply. It remains one of the more stable value markets as we head into spring. Let's talk about Niagara-on-the-Lake, where the market is actually freezing, because this is more luxury and lifestyle heavily influenced market. Detached homes dropped nearly 5%, down to about 1.1 million. Sales fell by close to 30%, and listings were cut almost in half. But what really stands out is days on market, soaring from 63 to 151 days. That's nearly double the time. It now takes about 5 months on average to sell a home, while inventory sits above 10 months. This isn't panic, it's patience. Niagara's market is lifestyle driven. It's not urgency driven. Buyers aren't rushing, they are taking time to negotiate. Turnkey homes near Queen Street and Lakefront still move, but rural luxury estates are sitting longer. For buyers focused on lifestyle or legacy, there is negotiating power. For sellers, pricing precision is key. Let's talk about Mississauga. Moving east to Mississauga, there are two very different stories unfolding simultaneously. Detached homes dipping just under 2%, averaging about 1.41 million. Sales dropped nearly 25%, and new listings were slashed by half. Yet, months of inventory rose to nearly 6.7 months, meaning homes are taking longer to sell even though fewer are listed. Interestingly, days on market stayed flat at 35 days. So what does this tell us? It means the homes that do sell are priced right from the start. Buyers aren't browsing casually. They are waiting, watching, and moving decisively when something fits. Townhomes in Mississauga are holding steady, with prices nudging up slightly by 0.3% to about 748,000. Sales dipped, listings dropped more than half, but inventory tightened, just under 5 months, a sign of steady absorption. For buyers needing practical space and manageable costs, this segment remains zone of confidence. Condos tell us a cautionary tale. Prices fell about 3.5% to about 506,000. Inventory rose to 8.5 months. This mirrors what we see across the GTA. Condos are digesting an oversupply, especially an investor-heavy pocket like Square One, Hurontario, and parts of Cooksville. The takeaway for Mississauga? Detached homes are stable but slower. Townhomes are resilient, and condos remain cautious. It's not a market of panic, but one of precision. The GTA story behind the numbers. So zooming out across Mississauga, Oakville, Burlington, and NOTL, there is a clear pattern that's emerging. Sales are down roughly 15 to 45% year over year. Listings have dropped between 40 and 60%. Prices are mostly flat or trending slightly negative. Inventory is climbing steadily. What that means is simple. The market isn't collapsing, it's calibrating, recalibrating, and finding balance again. We are in a transition, moving from correction towards stabilization. Buyers are cautious but still present. Sellers are patient but not desperate. Bank of Canada rate expectations are shaping sentiment, but real momentum will hinge on affordability improvements, likely mid-2026. Until then, strategy wins. Sellers who master pricing psychology, presentation, and positioning will capture the attention of the limited, serious buyer pool. Buyers who act when the numbers make sense, not chasing headlines shouting bottom, will quietly capture some of the best value opportunities we have seen in years. Investors, well, they'll need to pivot from chasing quick appreciation to focusing on yield. So, how to read the market like a pro? Let's break down some key metrics so you can read the market with confidence. First, we talk about months of inventory. Under 3 months means seller's market. Between 3 and 6 is balanced. 6 and above signals a buyer's market. Oakville detached sits just over 7 months. Mississauga detached is near 6.7 months. And Burlington detached is tighter, 3.76 months. That tells you everything about who holds negotiation power. Next, days on market. When days on market stay flat or rise slightly while inventory grows, that's not bad. It means buyers are active but selective. That's exactly what we are seeing in Mississauga and Burlington. Momentum without volume. Finally, we talk about price trends. When sales volume is low but prices seem stable, it's often data distortion. A few high-end or low-end sales can skew averages. That's why median prices tell a truer story. So when you make decisions, don't rely on one data point. Look for direction. Are listings falling but inventory rising? Homes are sitting longer. Are days on market stable but prices slipping? Buyers are negotiating cautiously. Are listings low but sales strong? Confidence is returning. The market always leaves clues. The human side of market data. Let's talk about this. Here is what I always remind my clients. Families don't move because of stats. They move because of life. Maybe a new job, a baby on the way, aging parents needing care, grown kids moving out. These are the real drivers why real estate moves, why people buy or sell homes. So when we talk about timing the market, what we really mean is aligning your life with opportunity. If your mornings feel rushed, if storage is overflowing, if your home no longer fits who you've become, those are the signals, not just numbers. This month's stats give you permission to slow down and make your move with clarity. Buyers finally have breathing room. Sellers can plan a thoughtful listing strategy instead of racing into bidding wars. This is the most balanced mindset we have seen in years. And that's where smart decisions happen. So what's 2026 outlook? As we move deeper into 2026, expect the story to shift from survival to strategy. Interest rates may ease slightly, not dramatically, but enough to revive confidence. Inventory will stay elevated through spring, giving buyers more choice. Prices will move in a narrow range. No crashes, but no big spikes either. The big theme will be migration. Families weighing city versus suburbs, lifestyle versus commute, cost versus community. If you are debating a move this year, the best thing is to understand your numbers, not the media's numbers, your numbers. What's your affordability, your equity position, your goals in the next 5 years? When those align, the timing takes care of itself. So in closing, I will say this. What do these December 2025 stats really tell us? That calm is returning, that buyers are back quietly but decisively, that sellers are smarter and more patient, and that opportunity belongs to those who do their homework. This is not a market for fear. It's a market for precision. Homes are selling. Families are still buying. But in 2026, the winners will be the ones who understand both the numbers and the feelings behind them. If you found this breakdown helpful, subscribe to the channel, share it with someone planning their next move, and tell me in the comments which city's data surprised you the most this month. I'm Jyoti Shamnani with Engel & Walker's Oakville, helping you make calm and confident home decisions in a noisy market. See you next time.